It's Sovereign Wealth Fund Wednesday at the World Investment Forum, and I'm going for an afternoon session talking about the global challenges and investment strategies of sovereign wealth funds. But here, just to tell you a little bit about yesterday's sessions at the Social Good Summit, a summit which is run every year on behalf of the United Nations Development Programme in Geneva to support impact funds and players in the social impact investment market, as well as provide a forum for some entrepreneurs to present their wares looking for investment directly into their businesses. So yesterday's session was an interesting one. We had a number of entrepreneurs from Africa, specifically in the agricultural and financial services field, very interesting businesses, varied, including some businesses in the health sector. The most interesting observation I can say from the African businesses is that the payments and financial inclusion sector is showing probably the most rapid growth and rapid scalability, but also comes up against the typical challenges that you'd have in both developed and emerging markets regarding providing access to finance to the poorer parts of the population. And these are businesses which are lending to largely uncredit-worthy or uncredit-tested, unbanked markets, but lending at high interest rates. Now, these businesses have very sophisticated, modern artificial intelligence algorithms to determine credit scores, much more sophisticated than is generally the case in commercial banking in these markets. But what is happening is, because of the sophistication of those credit models, they are producing very low portfolio at risk. And although they're doing this, and because they're testing the business model, they are still charging very, very high interest rates. So for the $10,000 to $15,000 loan range to retail and small businesses, the effective interest rate, or APR, on an annual basis in the region of 50%. On the smaller loans, the monthly loans, a couple of $100, in some cases a little bit more, the monthly rates can exceed 20%. So these are questions around what's the sustainability from an impact point of view on lending at such high rates if the ultimate portfolio at risk will go down. But what these business models are doing is showing that you can test a modern credit scoring system which will probably ultimately reduce interest rates and improve access to finance to the poorest of the poor. What I was doing at the session, I was presenting on behalf of SDG Impact Finance and talking to the session attendees as to how difficult it is to raise finance for a social impact business or for a social impact fund, and that often there's a huge gap between the understanding in the NGO sector and the financial sector as to what is required for a financier to be comfortable to invest in this sector, and ultimately how long it takes to prove a business model or to prove a fund model. And the message there is that there's lots we need to do in the sector, but there are no quick wins if you want to establish a new fund manager, a new fund, a new funding facility. This is an effort that takes years, it takes lots of resources, and also not only do you have to prove its robustness in terms of the financial proposition, but you also have to do so in terms of the impact proposition. So there's an impact measurement component to this. Yes, yesterday was a very useful session, very, very well attended, and a largely international audience. You can see, however, that there are a number of businesses in Geneva that have a long history of social impact finance, and this has really become a center for this area of investment, specifically in the European and African markets, but increasingly around the world. Off to the Social Wealth Fund session today, and we'll report back tomorrow on some of the events, strategies, and outcomes of the discussions, both panel and presentations at these sessions.